Good afternoon, everyone. I'm Jerry Jones, joined by JJ O'Hare from the O'Hare Wealth Management Group. It is our weekly update for February 27, 2025. Welcome to our weekly party where we take 15 minutes to answer questions, usually of a financial nature, that either our clients and or prospects have about the markets or what's going on financially in their world. If you have a question and you would like to submit it for us to discuss at a later time, please do so either by email or by calling and or texting us. We'd be glad to get that on. And there's a number. I like that. Thank you, Megan. Send us those at 414-644-0060. We've got a lot to unpack this week, a lot going on. We're going to try and keep the focus on the financial side of things this week and stay away from the political side. And with that, our first question of the day. I've been reading news about Warren Buffett selling off some investments. What does this mean? I know a couple of clients have already raised this question, so I'll let you take it from here.
It means the end is nigh.
No.
I'm kidding. That's not go too far. No, so there's been a couple of different things in the news. One, Warren Buffett's raising cash, and he's got a record cash amount. First of all, the company he runs, Berkshire Hathaway, is bigger than it's ever been, so you'd expect record cash amounts. But he sold famously 2 index funds, I think, last week, and they reported that for their quarterly. Well, you also have to remember, I think one of those was like 27 million or something. Like it's almost a minuscule position because he has $334 billion of cash. So,
Good point.
when you say, oh, he sold that position, there are times in our own portfolios where we sell small positions. But Warren Buffett also has a couple of different challenges that, and I'm picking on him specifically because that's the question we're getting. When he goes to buy a company, there are certain companies he might want to buy, but he would have to buy the entire company in order for it to make a difference in his portfolio. And that's not always feasible. A few years ago, he took Heinz private. He took the entire company in. But his ability to find companies at size and at scale that you can purchase, it would seem, based on his cash buildup, that it's becoming harder to do. This isn't the first time he's done this. And I believe it was 1988 where he bought Coca-Cola for the first time. And I might be off a little bit, but I think it was 1988. But people forget that the 5 years prior to that, I don't think he owned any stocks. And Jerry, what happened from 1983 to 1988?
I was in college.
The market did nothing but go up.
No, it did go up. Nothing but go up. And you were born
there was
that time frame as well.
Right. There was the 87 crash,
Yes.
obviously.
Right.
But remember, even the 87 crash, the market yearly return that year was 1%.
Still went up. Correct.
So, 1988, he missed 5 great years.
Really good years. Very good years.
And then he finally started to make a purchase. And he is very adamant that he does not time the market. He doesn't plan to time the market. He doesn't try to time the market.
Right.
And I can't tell you how many times in a quarterly letter he's written something along the lines of, if you're looking for me to time the market, you're looking in the wrong place. So is it interesting? Yes. Does it make headlines? Of course. I remember just a few years ago, I got headlines all the time about how he was selling some stock. And I said, yeah, but he's also taking Heinz private. He's actually taking more risk. You have to look at these things in aggregate, and you have to consider just because he's going to cash doesn't mean that the world is over, or that even that's the right strategy to take. And the fact that he sold 2 very small index funds in part of his positions, there are times where we get small positions built out through a spin out or a dividend, and we'll sell them
just daily business. Right.
Yeah, it's just part of what we do. Should we move to the next one?
I think we'll move on. The market seems to be acting nervous lately. What do you think is going on? And I've heard a few people comment they kind of have the jitters. Everyone seems very negative. What's our take on that?
Yeah, well, and it's funny because we talked about this. Just a few months ago, consumer confidence in the future of markets hit a new all-time record high going back 50 years.
Not that long ago. Yeah.
So now people are nervous, and it's kind of a vague sense of unease. And we kind of should be. We've had 2 pretty good years in a row. We just did our market outlook. I can't tell you that we were overly enthusiastic about buying this year. There have been years where we have pounded our fists on the table and said, it's going to be great. We need to buy.
Get in. Correct.
That was not what we said this year. We said, PE valuations are relatively high. The market's gone up a lot, and earnings need to come to fruition in order to make those PE multiples come down, or they need to stay. But if you look at March of 14, right? I think the market peaked March of 14. It went sideways for 2 years.
I remember.
And 13 was a great year. By the end of 12 and 13 were great years. But why did we go sideways for 2 years? Well, the market had to take a break. And the market has two ways to take a break. It either drops sharply, which nobody likes, or it goes sideways for 2 years. And I can tell you during that 2 year period, there were a lot of people who were frustrated the market wasn't going up, but they weren't complaining about the fact that the market hadn't dropped.
Right.
We just sort of went sideways.
I'm not making money. I recall those
Right.
comments.
I'm not making money, and
Right.
it seems like we just have a volatility drop, and then we come back to even and we go sideways. If the market gets ahead of itself, and we talked about this in the market outlook, if the market gets ahead of itself, it probably has to go sideways or come back down. Earnings, right? Profits and earnings are near perfectly correlated with prices of stocks. So all these stocks are up, but profits have not gone up nearly as much. And 2022 profits grew 5%. The market did not go up 5%. It went down 25% from January to October. And then the following year, 2023, market, earnings grew 0% in 2023. Great year for returns, right? So
awesome.
they're not perfectly correlated. So when people say the market seems nervous, but you have to take that 5-year outlook. And this is going back to our first question, even the Warren Buffett question. If you really believe in a long-term story, you kind of have to be willing to look silly for a year or two because you think things are going to be much better in the future. Mm-hmm. In 2014, if you bought in March of 2014 and you looked silly for 2 years, well, 5 years later in 19, you would have said, "Boy, I wish I could have bought anything back in March of 14. It would have been fantastic."
Brilliant.
Same thing here recently. February. It's February, right? 5 years ago we had, I think, just had a few COVID cases, right?
More than a few.
I think it was February 19th of 2020. The market hit a new all-time high, and that was the last high we'd hit for a while.
45,000.
So like 5 years and a week ago, we hit a new all-time high. You looked really silly if you put money in that day. But 5 years later,
brilliant.
You're probably still up 70%, buying at the market high before a 34% correction in 6 weeks. Mm-hmm. So you have to take that long-term outlook. So yeah, even if the market's acting a little bit nervous, you can't time the market. Please don't time the market. Warren Buffett would tell you not to time the market. Don't time the market.
We've told folks for years, time in the market is more important than timing the market.
So if you really are a long-term investor, you have that 5-year outlook. This is not a nerve-wracking period. This is a normal part of what happens. But if you're trying to make a quick buck this month, or the next 6 months, or even this year, yeah, you probably should be more nervous.
Which accentuates the purpose of these calls. In addition to our market outlook, we try to set the table and stay in constant contact with our clients to make sure they get the information from us first. Moving on.
All right.
What is the potential impact of an end to the Russia-Ukraine war? Zelensky's meeting with him tomorrow, allegedly. So where does that lie on our importance scale?
Well, probably is like a 0.1 out of 10. Look, all politics aside, you have to go back in time to 2022 when the war broke out. It's 3 years ago now. Mm-hmm. Seems like a long time. It was February 2022. We got all sorts of weird reports, right? And by the way, talking about being nervous, I'll come back to that. It reminded me of something else. But we got all sorts of weird reports. People said, "Oh, oil's going to be $150 a barrel, $200 a barrel, $300 a barrel again." Mm-hmm. I don't know if anybody's looked at it. It's barely hanging on to $70 today, 3 years later. That is not what anybody predicted as the world's gas station, Russia, invaded and was sanctioned for an invasion into Ukraine. Remember, Ukraine is the breadbasket of Europe. And, is one of the major wheat producers. Wheat prices were going to double and triple. And then, by the way, because of that, rice prices were going to go up through the roof. None of that happened either. So when the war unwinds, what's going to happen? The answer is probably not as much as you think. It's not like all the shipping lanes are going to be reopened and everything turns on a dial. It's a lot of things have not changed. It probably will help certain economies in Europe get a little bit more energy if the sanctions are lifted. I mean, there's a lot that we don't know, but ultimately, even when we were all certain we knew what was going on because of the invasion, a lot of those things didn't come to fruition. So you want to be very careful about saying, if this happened, then this must occur. That's not necessarily the case. And actually, going back to nervous about
you wanted to circle back to that.
I want to circle back to that briefly. The other reason the market's nervous is these austerity programs and Doge. I don't know if it's austerity or not. Austerity is the cutting of government expenditures. I'm pretty sure it's not stimulative because the government spending money is a stimulative endeavor. If they're really cutting funding, then it probably isn't stimulative. It's probably negatively impacting the GDP. But I can tell you right now, the reports we're reading, I've had certain reports say that this is going to mandate a recession because of the government cuts, and other groups of people telling me that it's less than 2 cents per taxpayer, and they've made no real difference. And the answer is, I think nobody knows.
Not yet.
And what does the market hate? Uncertainty.
Uncertainty, yes.
Right? They just want clarity around these things, and the answer is we don't have that right now. So if we don't have it right now, it's very tough for the market to get excited about going forward in an environment where we're not sure if any of this austerity or these government programs are actually going to have any effect, and if they do have an effect, on what industries, where, and how fast.
Correct. And I think you'll see things like the national parks first, or the IRS, losing 6,000 people. Those things may become apparent to us first before on the financial side we see anything that actually affects the markets.
But it's funny though. We've had government shutdowns here, even in the past 10 years, and does anybody really notice a difference? I'm sure people dealing with that particular department that day notice a difference.
Oh, sure you do.
But is it derailed the entire government when we had government shutdowns over time? No, it really hasn't. So, I'd say the same thing if we were talking about a government shutdown today. It usually doesn't derail the entire economy when we do that. It's frustrating. It can make certain business applications harder, but it ultimately is not a total determinant of whether the market's going to go up or not, or the economy is going to grow or not.
And that's one of the purposes of this call as well, too, to separate that noise from what really matters in your finances and what we're trying to do for you here at O'Hare Wealth Management. So we hope people understand that and get why we stay focused on how that affects their finances and remove the political side.
Well, and there's nothing but political conversation right now. And
exactly.
Like I said, we don't know yet. The things I've said about inflation in the past, you can make pretty good predictors about how tariffs are going to affect inflation.
Right.
But you kind of need to know what those tariffs are going to be. And, these austerity programs, we can probably make some predictions about how they might affect things, but we also kind of need to figure out what they all are before we start making bigger and bolder predictions, because things are changing rapidly. But ultimately, is it probably going to set us into a recession? No, the U.S. economy is strong. Remember, most of the growth is going to come from U.S. consumers. 70% of the U.S. economy is consumers.
And we keep spending.
Right? I think it's something like 19% is government spending.
Correct.
And then bonds, bonds are all over the place right now. And I saw somebody recently, bonds have come down big. They've come down like 50 basis points on the 10-year treasury.
Which is a big one.
In the last few weeks. They were, 4.8% not too long ago. Now I think we're at like 4.2, 2.5, 4.3. People are attributing that to all sorts of things. They're saying, well, obviously it's going to come down because the Fed doesn't need, because the federal government won't borrow as much because of all the austerity. Well, it also could be because they're expecting a recession or a slower growth path than we were initially anticipating. There's a number of reasons why the 10-year treasury might be down. But if you're looking for political backing to your political view, you're going to find it.
Yes, you will. We can search and find anything, as we talked about yesterday on the internet. Let's go ahead and move towards our close. Our next screen is our book recommendation. Last day for this one.
Proximity.
It's close. It's close to the end. See what I did there?
Yeah. So a couple of different things on proximity. This really was, if you haven't read it yet, it really was a good book talking about how everything gets closer to home. There's a big push now for people who want localized food and things like that, but we're actually probably going to be able to achieve more of those things. The idea of everything moving closer to us, it is amazing. It seems unconventional that you would have things close to home, but as a person who does 3D printing myself, I don't need to order stuff. I can print a lot of stuff at home. The proximity of it is as close as it can be and as immediate as I need it to be. So
I see what you did there.
What?
I can print it at home. You're killing me.
Also Goodreads. I know some people use that app. We're going to be on there now. We're going to start adding the books to our Goodreads. So if you missed a book or you thought, what was that one a few months ago? Hopefully it'll be easier to find going forward. And we're probably going to add some names that may or may not in the future become recommended lists. Maybe they didn't make the cut. Maybe we weren't sure. Maybe the market wasn't quite right, because we've added certain books like The Story of Silver, but that was also when everybody was asking me what silver prices were and gold prices were doing.
Right.
So maybe the timing of it isn't quite right. But quick preview for those who look at Good Energy is the next book recommendation.
Just arrived. I just got it.
Yeah, all right.
I have the hardback because I like to read an actual book.
I really like to read an actual book. We're not going to talk about it today. We'll talk about it later. And then we will, like we did last time, we're going to do a separate video just on this topic. But with that,
Thank you for joining us today. I want to welcome too some of our newer listeners. We've had a few new clients join us, which welcome to the O'Hare Wealth Management team.
yes,
And that gives me a chance to talk to you out there about referrals. If you have someone that you care about that could benefit from working with O'Hare Wealth Management, please put them in touch with myself, JJ, or any other member of the team, and we'd be glad to share with them the O'Hare Wealth Management story. On behalf of JJ and myself and the rest of the team, please enjoy these last 2 days of February. We jump into March. We march forward into the year on Saturday. Spring is close. Thank goodness. Have a great weekend.
all right, thanks everybody.